Our economy runs on spending. And when you spend money, you can either buy things with cash, money, or you can buy things on credit. When you buy things on credit, you are taking your future earnings and you are agreeing to use this money today. Like if you go out and you buy a car that you don't have the money to buy and you tell the dealer, okay, I will take this car off your hands and I will pay you my money in the future plus some interest to have your car today. That's what credit is. Well, every 50 to 100 years or so, people get loaded up on way too much debt, and this causes a credit crisis. What's up everybody, I am Jasprit Singh and welcome to the Minority Mindset. Every 10 years or so, we see some sort of economic crash because of what Ray Dalio, who was one of the most successful hedge fund investors and traders in history, calls the short-term debt cycle. And this short-term debt cycle crashes like this every 10 or so years, and it rides on top of what's called a long-term debt cycle, and this long-term debt cycle crashes every 50 to 100 years. We've all felt economic crashes before. We're seeing it in 2020, we saw it in 2008, 2001, 1991. In each one of these crashes, it's kind of the same thing. The economy starts to grow, and people start to feel wealthy, and they become more creditworthy, so now they go out and they finance a nicer car and a bigger home, and they're living larger, which is no problem, until we hit a tipping point where people have too much debt that their income can't support. In the beginning of the cycle, people have more income than what their debt can support, so people start financing more things so they can live larger, and eventually their debt starts to surpass their income, and then you hit a point where your income can no longer make payments on your debt, and this is what causes the bubble to burst and the economy comes down. When this happens, then people need to stop spending because they need to use their cash to pay down their debt, and when people are not spending, then businesses shrink and the economy gets smaller until it bottoms out, and then we start all over again. That's why it cycles. This short-term debt cycle moves in cycles, but these cycles also gradually move up a curve because each time, every decade, there is more money in circulation and there's more outstanding debt out there. So you kind of like have these economic waves that are moving up this bigger mountain. But if you take a step back, you'll see that these short-term debt cycle waves actually lie on top of what Ray Dalio calls the long-term debt cycle. This long-term debt cycle crashes like every 50 to 100 years, and most people don't even know it exists because it only happens like once a generation. And Ray Dalio believes that we are very late in this long-term debt cycle. He didn't say we're at the very end, but he said that we're very late in it. Just like how YouTube runs off of people hitting that thumbs up button below, have you hit that button yet? Our economy runs off of spending. So if you go to your store and you take $10 and you buy a bag of chips and some Fruit Loops, then you spend $10 and the store makes $10. The more money you spend, the more money the store makes. But the spending doesn't always happen with money, cash. Many times it happens with credit. I don't know exactly what the number is today, but the United States used to have something like 10 times more credit outstanding than it did money or cash. Like in 2013, there was something like $3 trillion worth of our cash out there and $30 trillion worth of credit. I come to you and I say, hey, I really like your car. Can I buy it for $10,000? And you say yes. That's when I tell you, okay, great. But I don't have $10,000, so I can't give you this cash. Can you just give me your car today and I will give you this $10,000 over the next 5 years plus some interest? If you agree to that, then we have just agreed to do a transaction and you and I have just created this credit out of thin air. Most of our transactions in America are done through these types of IOUs, this credit, because people don't have the money to buy all the things that they want, and this lets people use their future income, their money from their future, and spend it today. This part is pretty straightforward, right? I mean, people are able to spend more money than they have today because of the use of credit. But what you might find interesting is how your salary depends on how people spend their money. The more money you spend, the more money somebody else makes. And the more money that other people spend, the more money you make. If you make $50,000 a year and after paying all of your expenses, you are left with $10,000, and now you take this $10,000 in your pocket and you go over to the Gucci store and you give all $10,000 to Gucci to buy some scarves and a wallet or something. Now the people at Gucci just made $10,000 more. If you don't spend that $10,000 at Gucci, then Gucci's not gonna make that $10,000 and people at Gucci are gonna make less money. Well, if it's just you who doesn't spend their $10,000 at Gucci, then it might only be one or two people that make less money. But if we look at this across the board, where everybody stops spending money at Gucci, now the whole people, everybody that works at the company is gonna make less money. That's why the more you spend, the more people make. This is where credit or debt comes into play in our economy, because the amount of money you spend determines how much money people make, and the only way for people to make more money is for you to spend more money. And how can you spend more money? By using your future earnings today through the help of credit. So now, if you have just $10,000 in your pocket and your bank says, you know what, we'll give you an extra $10,000 to spend at Gucci. So now you have $20,000 to spend, and now you just double the amount of money you spent at Gucci, and now the people working at Gucci can earn more money because they're making more money. Gucci just doubled their revenue. So now their salespeople are making more money, their employees get bigger bonuses, and their investors are making more money because their stock shows that the company is making more money. But it doesn't end there. Now that the people working at Gucci are making more money, the banks look at these employees and say, wow, you're making a lot of money. We're gonna qualify you for more credit, more debt. So now these people can go and use more of their future earnings, and because they're making more money, the banks expect that their future earnings are gonna be even more. So now they can qualify for more debt and they can spend more money, and now hopefully some of the spending goes to your company so you can make more money. This is how the credit system works in America. I'm not saying it's right or it's wrong, this just is what it is. This is how it works. Some people can use credit in a way to earn more money than they normally could just with the money in their pocket. Other people, the majority of people, use credit in a way to spend more money than they can with the money in their pocket. When you borrow money, you are taking money from your future self, from your future earnings, and you're spending it today. Like if I go out and borrow $10,000 to buy a car, I have to take tomorrow's income and next month's income and next year's income and pay off today's car that I bought. Some people have used this credit system strategically to use their future earnings today to buy things that will pay them with income to build their wealth, while most people are using their money today from the future to buy things like Gucci that lose their wealth. It's human nature for people to want more. And so people keep piling on more debt, and eventually what happens is this is your income, this is your debt. People's debt payments keep going up and they grow faster than your income, and eventually people hit a limit where they have too much debt and their income can no longer afford their debt payments. Now you can't spend any more money because you need to use your money today to pay down all of your debts. And that's when this short-term debt cycle starts to come down. Now, remember what I said in the beginning of this video. The amount of money you spend determines how much money somebody makes. So if the short-term debt cycle comes down and people can't access any more credit and they can't spend any more money, that means people are spending less money, which means people are earning less money. If I can't find the cash or the credit to come into your store and pay you to buy your products, then you're not gonna make as much money as you did before when I was buying all of your candy and Fruit Loops. If people are making less money, then this tells the banks that people are less creditworthy, and so now people can qualify for less debt and less credit, and now spending slows down even more, and this creates this like vicious downward spiral of the economy through the short-term debt cycle. And this is where the central bank, the Federal Reserve Bank, comes in, and they can try to stimulate the economy by lowering interest rates to make borrowing money cheaper, so people can go out and borrow more money, get access to more credit, and start stimulate the spending again. Now, when loans are cheap, people will borrow more money, and if people are borrowing more money, they'll be able to spend more money. If you're spending more money, then people are earning more money. If people are earning more money, then they're more credit worthy, and they'll be able to qualify for more loans and credit from the bank. And if they can qualify for more loans and credit from the bank, they're going to spend more money, which means people are going to earn more money. And now this would push you into a positive economic cycle, and this would turn around the short-term debt cycle. So we're riding the short-term debt cycle up this kind of like mountain of debt, and the short-term debt cycle is oscillating every 10 years or so, and then every 50 to 100 years we hit the top of this long-term debt cycle peak, which the short-term debt cycle kind of just lays on top of. When this happens, the Federal Reserve Bank can no longer stimulate the economy by cutting interest rates. By this time, interest rates are already as low as they can go, because as you move higher up this long-term debt cycle, well, interest rates have to be cut at each kind of crash that happens along the way through the short-term debt cycle. And so interest rates keep getting smaller and smaller and smaller. And eventually you get to a point where cutting interest rates is not going to stimulate the economy anymore, because borrowing money and credit is already cheap enough. In the late 1930s and early 1940s, after the Great Depression, the cycle was starting over and interest rates were right around 0%. Then in 1980, interest rates peaked at around 16%. Then in 1990, they came down to around 10%. In 2000, it was around 5%. In 2008, interest rates came all the way down to 0%, again, to now stimulate the economy. And now, in 2020, interest rates are back down to 0%. At this point, the Fed could try to cut interest rates to negative as a way to stimulate the economy more, but there's a lot of debate as to whether that would actually spur the economy to grow even more. Now, when people and the economy hit this full-on debt limit at the end of this long-term debt cycle, people cannot afford to go and spend more money because they can't borrow any more money, and they have no more money left to spend because all their money is going to pay down their debts. And now what you see happen is people start selling their assets, their real estate, their stocks, their whatever, to make up for these added costs that they have to pay up for. At this point, the cost of living is too high to support people's incomes, and so people have to sell whatever they have just to make ends meet. This selling causes asset prices to crash. So stock market prices crash, real estate prices crash, and now credit vanishes because people are making less money, so they're less credit worthy, and so they can't qualify for as much credit, and so the buying power that people have just vanishes. Make sure you remember what I just said about credit vanishing, because you're gonna see why this credit disappearing is so important in just a minute. This phase is called deleveraging because now people are not using their money to spend, they are using their money to pay down their debt. The bottom of this last long-term debt cycle was right around the 1930s, 1940s, when interest rates were bottomed out at right around 0%. Then interest rates peaked around the 1980s, and then in 2008, interest rates came down back to 0%, and now in 2020, we're back to 0%. According to Ray Dalio's research, every time we enter this deleveraging phase, four things happen. We saw it happen in the United States in the 1930s, England in the 1950s, Japan in the 1990s, and Spain and Italy in the 2010s. First, people stop spending money so they can pay down their debt. Second, people start defaulting on their debts because they can't afford their payments anymore. Third, you see wealth defaults because asset prices start to crash when people start selling these assets, and people realize, oh, I'm not as wealthy as I once thought. And fourth, the central bank has to print more money to make up for this loss of credit and buying power. This phase is very difficult for the people in power and the people controlling the monetary system, so the Federal Reserve Bank, because during this time, people are making less money, so they're paying less money in taxes to the government. But government spending has to go up because more people keep losing their jobs, so the government has to fund these unemployment checks and stimulus checks, so there's less revenue coming in while the expenses go up, and so this is where you see the government deficit explode. At this point, for the government to continue funding people and cover this deficit, they're either going to need to borrow more money or raise taxes. But if people don't have any money, who are they going to raise taxes on? The rich. During this phase, according to Ray Dalio, you see more wealth redistribution because people have no jobs, there's a lot of animosity towards the rich, and it's the only way for the government to get the money to fund all these programs. But going back to the topic of credit, at this stage, people become less credit worthy because they're making less money and they have less assets, either because their asset prices dropped or because they sold their assets to make ends meet. And so the banks look at them and say, yeah, we're not going to give you as many loans as we used to. At this point, people can't go out and borrow more money and spend more money to stimulate the economy because they can't qualify for loans. And the Fed has already cut interest rates as low as possible, so they can't stimulate the economy anymore and spur buying by cutting interest rates. This is where now the Fed has to go out and start printing a whole bunch of money and pump this money into the economy as a way to make people feel wealthier and become more creditworthy and pump this system back to life. At this point, many people get worried about inflation because when you print more money, inflation happens and the price of things keep going up and people can't afford their cost of living anymore. But when you're in this slowing economy phase, what you're seeing is deflation, where the price of things are coming down as a way to make up for people not having any money. And so in order to combat this deflation, the Fed has to print more money. But remember what I said earlier in this video about how credit starts to disappear during this phase? Well, in our economy, spending happens through money, cash, and through credit. Well, during this phase, credit is gone. So all you're left with is money. So the amount of buying power left in the economy is very small. And so now when the Fed starts printing more money, what they're actually doing is trying to balance this equation by adding more money to make up for this loss of credit. So you're actually not seeing inflation if you do it the right way because this added money is just making up for the loss of credit, at least for the time being. There is a lot to balance here because you have to balance off printing money to fight off deflation and printing money to not cause hyperinflation like we saw in Germany in the 1930s where the dollar became worthless. This is where you really want to hope that the people in power and the people controlling the monetary system know what they're doing, because if you print too much money and you overstimulate the economy, now you risk just completely destroying the value of your currency, which is very bad. And if you don't do enough, then you risk this whole deflationary environment, which could destroy the economy, which is also not good. That's why you want to be right in the middle, right in the sweet spot. Now, I'm not trying to say that this long-term debt cycle is going to crash right now, but this is something that you want to be aware of so you understand how the system works. And if you do want to learn more about money management and investing so you can use your money the right way with the right financial education, we have a free ebook on money management and investing that you can read for free when you sign up for financial education emails, which are also free. You can get our free ebook and our financial education emails by clicking the link up here or by clicking the link in the description below. By the way, our financial education emails are different from our financial news emails. Thank you for watching. If you enjoyed this video, share it with one friend. That way we can help spread the word. If you want to learn more about how you can find a strong company to invest in on the stock market, I already made a video on it, and you can watch this video on YouTube by clicking this button right over here. Thank you for watching, and as always, keep hustling.